All right, back to our panel. Jerry Boyer says Wayne Angel has the story right. Fed was too tight on the way up, and it's high time for them to ease off, coming back down. Dougie Cass, I want to ask you about that point of view, and I want to ask you, Doug, some people are saying we have now seen a stock market bottom with a 10% correction. I kind of know what your answer is, but I want to hear you say it.
I think that we can distill the outlook for the market and the economy in one question, if we can answer it, is what portion of the past prosperity in the last 5 years in both the real economy and in all those investment vehicles that dot the world, i.e. hedge funds, has been based on the egregious use of debt and leverage. As Bob said, we're transitioning from a period of high liquidity and low volatility to a period of low liquidity and high volatility. And as the cartoon character Pogo's best friend Porcupine said once, it's going to hurt going through this stuff.
Doug, is this a liquidity problem or is this a solvency problem in the financial system?
It's a solvency problem, and I agree with Jerry. I think the Fed is going to lower interest rates. I believe we're going to have the kind of Pavlovian knee-jerk reaction in the equity markets. We'll get a vicious rally in what is increasingly looking like, unfortunately, a bear market, and it will be a great opportunity to reduce positions. I came on your show 2 times ago, on July 23rd, the evening before the beginning of the decline, and I said it was time to panic. I think it's too late to panic right now, but it's not too late to reduce positions, and your average investor, whether he's an investor, a speculator, or a trader, should have below average size positions and take advantage in what is increasingly becoming a two-sided market where you can make money on the long and on the short side.
Are you, look, America's most famous short seller, that's how I regard you, Doug, as well as a personal friend. Are you telling people that they should be buying in here?
Oh, absolutely not. No, I think that the case for a very lumpy period of economic growth and fits and starts in which investment managers and corporate managers alike will have a difficult time navigating is upon us. And I think, you know, I'm talking my book, but I really believe that everyone should have some exposure to the short side right now.
Quinn Hardy, I want to see how you see it. Are we close to a market bottom? Do you expect the Fed to ease? Weigh in on these great questions of the day.
How do I feel, Larry? I feel great. And I'll tell you why. Because now all these swaggering Republicans and libertarians who are down on welfare and down on big government and down on individuals who bought subprimes and say they have to pay a price, you give me a 10% correction in the market, and suddenly it's like, oh, please help me, Uncle Sugar. Oh, please, Fed, pour billions into the market. Oh, please buy our junk. Oh, please be our financial love monkey. Please tell us there's a stock fairy. My gosh, guys, it's time to be grown-ups and accept you bought some junk. It was no good, and it's got to clear out. Do not expect the government to bail you out.
Well, what about the Federal Reserve?
Larry, I would add also.
Hang on, let me go. Jerry,
okay,
Quentin, do you want the Fed to fiddle while the banking system might burn?
10% correction, Larry. Stop freaking out.
Not stocks, banks. I'm talking liquidity and credit. There is a credit virus. There is a freeze-up in credit functions. The 3-month Treasury bill
so
has
when it happens
completely
on Wall
collapsed
Street,
in
it's
rate.
not big government. It's setting things right. It's not corporate welfare. It's setting things right. Man, these guys painted themselves into a corner, and they want the government to bail them out. It's as simple as that.
All right, so we'll call that the let them burn scenario.
Well,
John?
maybe you say. I think they can set it right on their own hook.
All right, her own hook. John Brown, I'm in the strange position of you and I are on the same time now. We both want the Federal Reserve to ease. I have a feeling, though, your longer-run view is not as optimistic as mine. What are you thinking here, John? You've seen this thing playing out in the last week.
Well, I knew positive thought would bring us together because we both agree on so many things. And I was thrilled to hear you say that. I think you should no longer be Sir Larry, but now Lord Larry. It's wonderful. I disagree slightly with you. I see the problem, and I think Wayne Angel was quite correct. We are heading for a very, very serious situation if we allow the lack of liquidity, not to the banks, which are fine, but to the consumer and to small business. At the moment, the Fed is pushing on a piece of string. It's issuing liquidity to the banks, but the banks won't lend. In fact, they've raised their lending hurdles. So liquidity's got to be got to the consumer, who is key to our economy, 70% of the economy, and to small business.
How do you
and that
do
can
that?
only be done with lowering interest rates.
Right. Right. That's it. No,
And I agree entirely with you. I'm thrilled to hear you say that.
I agree. Jerry Boyer, before we go out in this panel, I think I heard a blistering attack on free market supply-siders by Quentin Hardy.
Yes.
Do you care to respond to that, or do you want me to?
May I, please?
Yes.
Since when is it bailing out when the Fed simply supplies the amount of liquidity that's necessary for a growing economy?
Right.
When the Fed is targeting
subprime
mortgage
the
bundles that
the
you don't want
bailout
anymore, you are having them buy you out of a deal.
No, we're doing
The bailout argument was when the Fed is used to buy
We're not
profit waste.
hypocrites.
Quentin, if you don't want a central bank, then we can abolish it. But when it's there and it's in control of the money supply, it's got to issue enough money, and
It's not
too
big government.
tight.
It's not corporate welfare. You're right.
It's not corporate welfare when the Fed does
right.
what the Fed was created
That's
to do.
right. It's on Wall Street helping out the guys.
You know, Quentin,
I don't know
that's very interesting. You would have fit in very nicely. You would have fit in very nicely with Andrew Jackson and Martin Van Buren in the middle of the 19th century.
With Bill Ford, who
Hang
said
on a
this in the
second.
last segment.
Bill
just a little less directly.
Bill Ford didn't say that. Bill Ford's a former central banker. But what you're saying is you don't even want the Fed to lend a hand when the banking system is illiquid.
You're the one who's declaring it illiquid, Larry. It's not that far gone yet. Bill Ford said you're taking the moral risk out of it. You're letting them get away with it. That risk's another bubble.
Look at the 90-day
Give me a
bill.
break.
Look at the 90-day bill. It's illiquid. We have a liquidity problem. That's why we have central banks.
Market come back up today,
punish us.
340 points. Looks like it was correcting to me. Looks like it took care of itself.
Oh, I think that's people calling the bottom. I mean, look at the last couple of weeks. There's a lot of stuff going on here. We have an inverted yield curve. We have commodity prices falling. We have commodity-sensitive companies getting beat up today. We have a deflationary problem. The Fed's been too tight.
Right. When it comes to working people, the government should get out of the way. When it comes to the Wall Street people, they should be the love monkey.
All right. Well,
I don't even know what that means.
Some people believe adding liquidity is good for growth and for employment, but we're going to come back to this. I can see we have some disagreements. I'll just chime in by saying my mentor, Arthur Laffer, has been on this program for the last, 3-4 months, talking about the 3-month Treasury bill. The bill has plunged in rate. That has to be a signal that there's something amiss in the credit system and liquidity is lacking, and therefore that's what central banks are for. But if we want to eliminate Mr. Badgett, let John Brown talk about Mr. Badgett and central banking.